All right, welcome back, guys, to today's class of Module 7, which is a price action. Today, I will be making a coverage of Module 7 to 10, which is the last. I will just summarize them so that we can dive right into the chart. We'll see all that which we've been saying in the theory aspect. We'll be seeing them live on chart, practical aspect on chart. So we won't be wasting much time. I'll just use today as a summary of the rest videos, module 7 and module 7 to 10. So taking a look at module 7, we say module 7 is just, I titled it as a price action mastery, which is an advanced class. So which means if you understand the previous videos, that's the reason why I make those previous videos separately, because they are video of beginners and medium stage. But right now, this one is a video of advanced classes, and from 7 to 10 are both advanced classes. So just to save the time, I decided to put them all together in one video. So let's take a look at it. So price action mastery, we say this is how the big boys, that's the bank, trade. We'll stop using basic retail tools and look for institutional footprint. Remember in the last video we were talking about indicators, using indicators to trade. But when it comes to price action is just you analyzing the chart, taking trade based on candlesticks instead of indicators. This is what I actually mean in this area when I said this is how the big boys, that's the bank, trade. So you as a retail trader, your own duty is just to tag along with them, using their own strategy to follow up with them. But as an indicator trader in the previous class, which I talked about, trading with indicators, sometimes you can trade against the big boys because your indicator tells you to do so. It either tells you to buy when the major trend is bearish. So scenarios like that, you end up losing money. Well, because indicators are not always in line with the big boys. So for you to be in line with the big boys, you need to know what price action is, follow price action, analyze the chart. So under this price action, I point out some things which I majorly use to trade as well. I use order block and liquidity hunting. I also talked about it right here. When I say order blocks, banks don't place one trade, they place thousands. Another block is a zone where money enter, where when price return to this zone, it usually reacts aggressively. I don't know, some of you, which if you open the chart, when you open the chart, you see a particular point where you see the way price returns or rejects. It either returns or rejects from that level. That point where the price returns or rejects is the order block, where the big players are in the market. So when we talk about liquidity, we are talking about the point where price immediately, or if you notice this sharp move in the market, you notice maybe one candle move, you just sweep through a level, and after that the price will now reject, and let's say for a bullish movement, for example, price got into a certain high, it came down, just immediately sweep through a level to the downside. After that, it rejects back up again. You see it going back up. That level that is sweep is actually a liquidity zone, and the sweep right there is called liquidity hunting, or you can also call it liquidity sweep. And then the second move that price makes after that liquidity sweep is called liquidity grabbing. So let me further talk about this liquidity hunting. In this area, we say banks need liquidity to fill their huge orders. They often push price just past support or resistance to trigger everyone's stop losses. and that stop loss is regarded as the liquidity in the market before moving price in the real direction. So you just have to learn to wait for this hunt to finish. If not, you get stopped out in the market as well. So let's take a look at the Model 8. Model 8, which is the risk management. I know I've been ringing bells hell on this risk management of a thing, and I hope you pay strategic attention to risk management. So risk management, you can have about 90% win rate and still go broke without a proper risk management. Yeah, your strategy can be so good that you have a trade of 1:1 risk to reward. Let's say a risk to reward of 20. Yeah, over the past few weeks, this week that just ended, I have series of those trades that which I took because I'll be working on a new strategy right now where I'll be risking 1 to get 16, 1:16, 1:20, 1:10, depending on the target point. And so far I've been having those trade on 1:5, I've been having trade of 1:4, 5, and maximum of 6, which of course is a rare scenario. But right now I've been working on a new strategy which has been giving me 1:10, 1:16, 1:20. I believe on USD card, I opened a trade which is currently on. I didn't close it. I decided to take a weekend trade on that USD card, just testing that strategy out. The entry was about 1:16. Let's see how it plays out next week. Then I'll probably make a video on that trade. I actually had a 2 position on that trade. I decided to try in a small account, about $10 account. Let's see how it's gonna play out. The first entry which I'm supposed to take, which was yesterday. Yesterday happens to be school days. I was busy with school stuff, so I missed the first entry. The first entry was about 1:20, 1:20, 1:23 thereabout. Then the second entry, which I caught after the school period, that is about 1:16 risk to reward ratio. So let's see how that strategy plays out in the next couple of months, which I will be testing out that strategy. If it plays out well, probably I will make a video of that strategy for you. But for now, I'll be giving out a strategy which, of course, I'll be working with over the past few years of my trading. I'll be giving out that for now while we'll wait and see the results of this recent strategy that we're working on. So one thing I always make mention about under this risk management is this number 1% rule, rather. I mean 1% rule, risking at least 1% of your account. That's if you're trading $1,000 account, you risk 1%, and 1% of $1,000 account is $10, which means when you're trading $1,000 account, you should be risking at least $10. But for we that are retail traders, trading with $10, 20, 30, 40, maybe to 100. Let's use 10 for example, because I usually take 10 as the least retail trader for me, because that's what I usually trade on most of the time. So if I want to create a small account, so let's use 10 for example, $10. So what's now your risk on $10? For every trader that wants to trade with a $10, I recommend a maximum of $2 loss. You don't take more than that. A maximum of $2 loss. If you have a trade of $1.8, that's $1.80. That means you're already risking your $2 already. Don't take any other position. Just allow the one you've taken to play out. So on a $10 account, you have a smaller chances of error. So you just have to be very strategic with every move you make, every decision you make in the market. If not, you'll be purging out, like market will purge you out. So for a maximum of $2 on $10 account, the person has, let me just say, like 5 lives. So in that 5 lives, you have to be strategic with every position you take. If not, If not, you're gonna be purged at time. Before you know it, you blow up your account. It takes discipline and patience to trade a $10 account. It's really not easy, especially for beginners or traders. I've been in that stage, and I know what I passed through in that stage. The frustration to the extent that I thought of giving up forex trading. Yeah, I thought of giving up forex trading. So I'm also making this. I'm also saying this point now to reach out to those of you that have encountered frustration in one way or the other and wants to give up forex trading. Don't give up. There is light at the end of the tunnel. All you just need now is to be careful. Find your little touch to find the way to the tunnel. So there's a brighter light at the end of the tunnel. Okay, so keep up, and continue learning. Never giving up. Never give up. That's just it. In my own case, for about 3 to 6 months, I wasn't in the market or playing out anything. I was like, maybe Forex is not for me. I have a destiny somewhere else. When it comes to Forex, everybody can trade it. Both big, small, dull, brilliant, medium, brilliant, anyone at all. They can do it. It's just like a skill. Everyone can do it. So on a $10 account, which I will also be which I will be using, I won't be using this $1,000 in my sheet right here. I'll be making an order of a $10 instead of $1,000. On a $10 account, you'll be risking a maximum of $2 per day. When I say $2, I'm not saying that, okay, you risk $2 on a trade, like, because it's narrow for me, I take like 2 to 3 trades in a day. So that means if I'm taking a $10 account, I have to limit my number of trades, because this is a $10 account and risking $2 per position, which is in a day I'll be risking $6. So in scenarios like that means within a day or two, my account is probably gone. So such an account, you trade one position for that account. And before you take that one position, you have to be strategic with it, with everything, and careful with your decision making. Yeah. Strategic and with it, and smart with decision making, smart in decision making. And above all, you should also look out for a smaller stop losses. On the $10 account, from me, my trading strategy, I will recommend a maximum of 20 pips. Don't take trade more than 20 pips. Yeah. So on a 20 pip stop loss, you have a 0.01 lot size. On a 10 pip stop loss, you have a 0.02 lot size. That's the $2 you're risking. And one other thing, trading a $10 account, if for any reason you have a loss on that day, you should stay away from the market for about 24 hours. After 24 hours or 48 hours, when you come back to the market, clear out all your analysis on the charts. Clear out everything, start all over again, analyze again. The price might probably be changing bias for that day. That's why you end up in loss. So giving in about 24 to 48 hours for price to reset its bias. After then, you coming back into the market, you clear out everything, so that you can know the recent market bias, where it's going in next time, where it's recently going. Then you can tag along and make your money from there. So risk to reward ratio. Never take a trade where you risk $1 to make $1. I've said that in a previous video. I'm still saying that right now. You should always ensure that your trade is 1:2, 1:3, and above. Okay, right here I say you want to risk $1 to make $3. That's 1:3. And I really love 1:3, because sometimes taking 1:2 is okay. To take 1:2. I never said that's bad. It's okay. But for small accounts, That is why I will say 1:3 is quite okay. It's much more advantage compared to 1:3. Imagine for a small account of $10 now, which I will continually be using as an example. For a small account of $10, you're risking $1. Okay, let me say maximum of $2, which I said earlier. You're risking the maximum of $2 for that small account. You'll be getting $4. 2 to 4, that's 1:2. Like, you feel like this is a slow growth. Yeah, some people were like, this is a slow growth. And maybe if the trade later turns out to go a little further, you say, I should have hold this thing. I should have hold that. I had such thoughts. This such psychology actually happened to me. So, most of the times when I look at the market, if, for example, for any reason, price violates 1:2 and decided to go a bit further, most of the times price gets to 1:3, 1:4. Most of the times, very much, except you didn't get the entry at the right spot. Maybe you enter at a trend continuation. That's when you won't get 1:3 or 1:4. But if you enter at the right position, the right reversal point, you're definitely gonna get 1:3, 1:4 trade. Yeah, price do run that many times. I've checked that on various pairs that I trade, USD card, Euro USD, because those are the pairs that I trade. I don't know about others. I check that on Euro USD, USD card. Recently I added 2 other pairs, AUD USD and gold. Though I'm still studying gold to see how price is gonna be. I'll be hoping to get a very let me say, taking my entries on gold in 5 minutes, 1 minute. Let's see, especially in 1 minute. So I'm still studying my strategy on gold on that. Let's see what 1 minute is gonna produce on that. If I'm able to sort out a strategy for gold, then I will be trading gold as one of my. But the volatility of gold is quite huge. So it's because of the volatility, not that no strategy or the strategy run that I have cannot trade it. It can, but the volatility on gold will increase my stop loss. And in a scenario like that, I wouldn't want to be risking a whole lot of money on a little account. That's really, really bad. That's the reason why I decided to let go of gold. If you happen to be trading a few thousands of dollars account, then taking a gold is quite fine. Then you know that on 100 pip you are risking, because recently gold runs 100 pip stop loss, if I'm not mistaken. So on 100 pip, let's assume you're having $1,000, and on 100 pip you should be risking like $10 for 0.01. Unlike trading a few dollars account, and you're taking it just like you're making the decision of blowing your account within the next couple of minutes or hour. That is why I decided to give gold a break. So let's take a look at the trading psychology. The trading psychology right at this point. So these are the major 3 things which also involve the advanced plans. I'm just putting them in summary here, because you can't just get all these things in one go. You have to get them as time continues, as class continues on. So since it's not something you can get in a theory class, why taking long with a theory class? So I decided to put them all together just in one video. Let's take a look at this trading psychology. Trading, or let me say your strategy. Have you heard of the saying where they say, some people say your strategy is just 20%, some say strategy is 10%, your psychology is 80, some say psychology is 90. Right here I said trading is just 10% of your strategy. That's what price, like market, that's what is necessary in the market. It's just 10% of your psychology, but 10% of your strategy, but 90% of your mindset. Because most of the times, most traders that turn out to be to lose out in the market. It's not because they don't know what they are doing or they don't know what to do or what is going on in the market. It's just because their mindset, seeing the price counting against them, like maybe $1 loss, $2, $3, like, God, what's going on? What's going on? Before you know it, they exited the market and then price go in their direction and losing out a whole lot of money. The opportunity to make a whole lot of money. They do that. And some scenarios, some traders as well, it's not because they exited the market, but sometimes they were like, this stop loss is too big. If trade goes in this way, my account will blow up. Then why did you take such a huge lot size? Since you know the stop loss is huge, you should have reduced your lot size. But now, if you want to make money, increase your lot size. Now trade, maybe the price happens to swing, play against you. Like, this stop loss is too big. My account will blow. Then you tighten your stop loss. When price chooses to reverse, before reversing, price will have probably swing you up, take you out, maybe with 1 pip or 2 to 3 pips. You use that to take you out. Then price reverses into your direction. Like, God, why me? Why me? God didn't do anything to you. Like, this market is a scam. He knows when I enter. He knows where my stop loss is. So you first of all go there. I've had a scenario like that. Someone have said that. Say, these people, they know where your stop loss is. They knows it. So they will go there, take your stop loss and go in your direction so that you not make money. It's because you tighten your stop loss. There's what we call breathing space in the market. There's spread in the market. So when you enter your trade, you get your stop loss. Let's say stop loss of about 5 pip. You give a trade breathing space. I usually give my trade breathing space of 2 pips in addition to my actual stop loss. So there's a breathing space even in your relationship. When the relationship is quite toxic for you, it's been a little challenging. If you're facing ups and downs, you're like, let's take a little break. Let's give each other a space so that we realize ourselves. Is it not? Even in the sweet relationship as well, when it's becoming too sweet and all the loving-dovey and all the time, you get to understand that one party or the other, like, this person will be suspicious, like, this person is doing this just to make sure that is he trying to play sweet for me, just to capture me, put my mind in this side. That's just it. This is a human world. In the human world, there's no 100% of one thing over the other. Yeah, it's either 70% of the left side, then 30% of the right side, or maybe 50-50 or 60-40. There's definitely no 100%. That's just it. So in the forex market, you're trading, having a stop loss of 5 pip. You should also give it a breathing space, space. Just like GBP USD, which I often say that is a stop loss hunter. In a trade like that, trust me, GBP USD will hunt your stop loss, take out the 5 pip that you set your stop loss at, and then continue your way. You're like, God, GBP USD is a devil, is a demon. You know where my stop loss is? No. It just has this attribute of hunting stop loss. So what you just need to do is to extend your stop loss, give it a breathing space. Yeah, that's just for GBP USD. You just give it a breathing space, because GBP USD, when it make a drop, they know where that drop, like, it's just like, you will know where market say a break of structure, higher high, lower low. So something like that, coming down here, you just make a sweep of the low or the high before going into the direction. You giving it a breathing space is it means like when price comes to take out this low or this high, it will still be in my favor when it decides to make move. So going back to the trading psychology, I have a few things that I outline here: the revenge trade and patience. Revenge trade. After a loss, you trading a small account, like $10 account, which is why I said you should minimize your trading, your position in the day to one position. So you should never revenge your trade. You lost your dollar. It's just like a contract between you and someone. You make a bet. It's okay. This thing, okay, let's use the regular bet which we all know, the football team. Okay, let's say Barca is going to win over Manchester United. Then you make the bet. When the bet, like when it comes for you, you make your money. But when it goes against you, you accept the loss. Just leave it for the day. You're not gonna say, no, 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 it can't be. Man, you cannot win back. Let's go back again. You want to you want to set the match, or you want to tell them to play the match again. They've played the match for that day. That's just it. So that's it in the forex market. The advantage of forex market is that it helps you minimize your risk. Yeah, you minimize your risk. Unlike in a scenario where you'll be betting a whole thousands, or maybe if millions, that's if you have that in a betting slip, you can deposit your thousands or millions. Inside a thousands or millions, you can choose to risk a few of them. That's just it. You risk a few of them. And when it goes in your way, you make your money. If it doesn't go in your way, you accept it and stay up from the market. So when price doesn't go your way after a loss, the brain will wants to get back it. This money I need to make it immediately. This leads to over leveraging and blowing up accounts. So you shouldn't find yourself in that category. Don't ever revenge in trades. Then let's talk about the patient, which is also regarded as the silent mode. The best traders spend most of their time watching, not trading. If your setup isn't there, you do nothing. Doing nothing is a profitable trade because it saves your capital. You ask me how? Yeah, someone will say how? Okay, let's say while price is busy making noise in the market and you decided to jump in. What happens to your capital? You get taken out. Is that profit? No. Okay, there was a day I opened a chart and I saw Euro USD had been consolidating for a couple of days. When I checked it in my 1 hour time frame, I found out that the consolidation was quite too much. And because I use 1 hour order block most of the time for trading. So, seeing my 1 hour order block, both the buy side and the sell side order block, quite a bit, few pips away from the stock, from the ranging market, and I noticed that the market has just been in that range of. What I would do is just to stay out from the market. I mark out the range as a liquidity, both the upside and the downside ranging as liquidity for the buy side and the sell side. That's just how it is. You just have to be patient. Not that, today now, price didn't come to my order block. How am I going to take this trade? Let me go to lower time frame. Let me go and find entry. Let me open this area. Then you maybe dive to 1 minute or lower time, whatever time frame, just to find entry. And before you know it, you end up losing your money. So 1 hour is just like a medium time frame. When you see consolidation in 1 hour, you should know that, okay, you should stay away from the market. Yeah, 1 hour, most of the time I use 1 hour to make decision. It's just like my medium time frame. If 1 hour seems to be consolidating, that means until that consolidation is taken out, I'm not going to trade for that day. So you staying away from the market for that day, just because you see a consolidation in the market, is not a loss to you. Why? Because you save your capital. You didn't lose that $5 or that $2 that you wishes to risk. You didn't lose it. It's still there. You can use it another day. That's the growth. Yes. You found out a loophole that you almost fall for. You found out that this loophole, or let's use bump on the road, because like for people that walks in the way on the road, like at the middle of the night you are walking, you found out there is a bump or a loophole on the way. Instead of you falling in that, will you purposely, like seeing that loophole, will you open your two eyes and jump into it? No, you rather avoid it. Take an alternative an alternative way, just to avoid it. Is it not? That's how it is in the forex market. Since consolidation, you have to avoid it. And when you avoid that loophole, it saves you the stress of like, I sprained my ankle, maybe because you stepped on it and you stepped in, maybe you fell into it or get stained or strain your ankle, something like that. It will save you just stress, those pain, those excuses and all that. That's how it is in the forex market. When you also stay away from this consolidation, it will save you the $5 or the $2 you wanted to risk. But when you don't decided to indulge in it, like someone that is working overnight without a touch, he didn't send the loophole, then he walk down there, step in it. He probably fell, injure himself because it's a tie road. You injure yourself or stain yourself or strain your ankle. Whichever one, there must be one casualty or the other. That's why in the forex market as well. When you see a consolidation phase and you decided to like forcefully find entry just to make sure that you trade for that day, you'll definitely be a victim of one trade or the other. You'll probably get a position which was maybe 5 pips in your profit after they takes you out on 10 pips. Or you might get a position that was like 2 pips in profit for after then takes you out in maybe 15 pips stop loss. That's just how it is. You must have that loophole in the forex market since you've seen it. That's why you need your touch and your torchlight to work in the night. And that torchlight you need in the forex market is your analysis, your price action analysis we talked about earlier, to analyze your chart. If you don't analyze your chart, you will be a victim of stop losses in the market. Trust me. The last one, which is the 10th one that I will be talking about, is Profim. We won't be talking much about Profim because your beginner stage, but I'll just throw a few highlights upon that. How to trade, if you want to trade your $50 profit, $50,000 profit rather, I mean, $10,000 profit or whatever profit you wishes to trade, they are all gonna be the same strategy. And it's gonna be the same observation. So passing the evaluation, Profim gives you a test. When you get a Profim account, it gives you a test. You must hit where you need to hit a profit target of about between 8 to 10%, depending on the prop account, without losing more than a certain percentage. With some uses about 3% percentage of the account without losing more than 3%, some 5, depending on the prop account. The key is just a low risk management and high patience. There's no difference. It's just the same. The only thing is that you just need to lower your risk management and be patient. All you just have to look out for a trade that gives a higher risk to reward so that you can risk a little to gain more and pass your proper account. Then the payout mindset. Once funded, your goal is not to get rich in one day. Yeah. Let's say, for example, someone gets a proper account of $10,000 after trading the simulated account, which is the test phase. You passed it and you get funded. Some people like, I've been funded. Right now, let me pump the market. Let me shoot the market so that I can make money and withdraw as soon as possible. Let me go and borrow. Let me go and do one or two things. Yeah. Every trader will have the mindset like, okay, we need money to do this or do that. But one thing is that once you are funded, don't let the mindset of getting money as soon as possible to be in you. When you get that mindset, you will end up blowing your funded account because when you get funded, it's not your money. Remember, it's a prop money. So they will still give you some rules that you need to follow. Though they might not give you a maximum profit target right now. You can trade as many as you can, make a whole lot of money that you wish. But they will give you a stop loss target. You shouldn't trade more than this stop loss. You have a daily lot allowed, daily loss permitted. You have a maximum drawdown loss permitted as well. Those things, you should pay attention to them. If you don't pay attention to them, like, let me make money, you end up blowing that account again. So once funded, your goal is not to get rich in one day. It is to get the first withdrawal. I'll call the first withdrawal your capital. Yeah, even though you you bought the account with $50 and your first withdrawal is like $500, I'll still gonna call it your capital. Yeah, because trading with $50. How will I say? For that's for someone that knows what he's doing. Trading with $50, can also make that $50 into $500, even thousands of dollars. So your goal is to make your first withdrawal. Once you have your own profit in your pocket, the pressure disappears. The pressure of this account, how do I manage it to make more money, to make money without losing it? All those things will disappear because you have your $500 in your account. And in your $500, let's say if you needed some money for like the needs or necessities, 100 to 200, or let's say $300 is quite enough to take care of that. The other $200 remaining, you can make a deposit of $100 to your normal broker, to your broker, while your $100 extra will just be like a backup plan for any necessity or any emergency that comes up. While you're still trading another account as well, you are still trading your proper account, rather your proper account is still there, you're still trading it. So with that, you have the peace of mind. You know that, okay, if you need money for anything, you have the money that you can use to do other thing. While you can have that peace of mind, settle down, you can trade your proper account fully, then you can make that crazy money that you want to make. You can decide, okay, I want to trade this account to like $20,000, withdraw it, and then go and buy the so car that you have in your mind. Well, some brokers, they don't pay up to that. That's why some traders will withdraw every possible profit they make in the market. So some brokers do pay that, yeah, well-trusted brokers like Funded Nest. I believe FTMO is also one of them. When you trade up to thousands of dollars and you place withdrawal, you get paid for that. Some brokers might like find some excuses or stuff like that not to pay off the thousands of dollars. Probably because they are not that buoyant, financially buoyant enough, or maybe they've not grown big enough. So when trading brokers like that, every dollars, every penny, every cent you make in the market, you take advantage of it to withdraw it, never leaving it. If not, you might find one excuse or the other to seize your money and say that you did this, you did that, you violate this, you violate that. That's why you're not going to pay you. So that's it for today's class. That's the end of the whole theory so far. And in our next class, we'll be talking about practical aspect in forex trading. In the next class, we will be doing the practical aspect of forex trading. We'll be going into chart, finding how to analyze the chart, do price action, and then I'll also make a video on how you identify liquidity, the buyers in the market for you guys. I can't say when that video, I know I've said it, this is the second time I'm saying it, but I can't say when I'm going to make that video specifically, because there are other things that keeps a man busy. But until then, definitely I'm giving you my word and I'm going to make that video on liquidity, how you identify liquidity in the market, how you identify inducement, and your buyers, to know your buyers in the market as well. I'll make videos on that as time goes on. So that's it for today's class. See you next time.